let's say if you wind up not being able to repay, and they'll say, okay, we'll charge you $1.50 for every $1,000 that you default, right? It's usually like an optional. I don't know what to describe it, like an insurance for the consumer that will basically cover them in the event that, let's say, they're unable to pay because they got laid off or they have a disability or death or whatever the case is. Is that kind of related to this?
That's another swindle.
That's different. Okay.
The finance charge itself already covered the life of the loan, the credit life, and protects the up. Let's pull it up so people can see. 15 USC 1605.
Go ahead. You can share.
So what they're actually getting now is they're getting their cake and they're eating it 2, 3, 4, 5, 6, 7, 8, 9. That's what's going on. So when we go to Truth in Lending, 15 USC 1605. 15 USC 1605, the termination of the finance charge. Finance charge defined. Except as otherwise provided in this section, the amount of the finance charge in connection with any consumer credit transaction shall be determined as the sum of all charges, payable directly or indirectly by the person to whom the credit is extended and imposed directly or indirectly by the creditor as an incident to the extension of the credit.
What's going on, everyone? So look who we have again. We have the man of the hour, Daraine Delevante, man. So first of all, I'm still sort of just reflecting on the credit summit, right? Because for those who don't know, the credit summit was fire. I've never, been in that type of atmosphere where basically you had a sort of a who's list of, people in the financial and credit space. And, shout out to you, Daraine, for getting all these people together in one place at one time. I was saying, going forward, we're actually probably going to have to go on tour, different cities, because, man, the amount of information was just crazy at the credit summit. So shout out to you for, putting that together. And I can't wait to the next one.
Let's see what cities the people want us to go. So if you're watching this right now and Credit Plug just said it, so we can't take it back now. A tour, what cities would you like us to visit? Like, where would you want us to come? Because we might be thinking, let's go to Tampa, or let's go to Miami, or let's go to New York. But then we got somebody that might say, no, we need you in Arkansas. We need you in Detroit. We need you in Delaware. So I'm curious to know now, like, where would you want us to go? I'm curious.
So I'm gonna tell you 100%. I've talked about this as well, and as you mentioned, it's like a group effort, right? Getting all the people together. But DC, Maryland, Baltimore area, 100%. We got people up in the New Jersey area, tri-state area. There's Philly. Yep. Of course, Atlanta's like the epicenter, but up and down the East Coast, and I even talked to people. I talked to someone at the credit summit, and they were like, man, I think they were in Tulsa, Oklahoma, and they were saying, man, there's no sort of movement like there is in Atlanta in those areas. I would say even in the DMV area, it's a little bit different, right? It's not, I would say Atlanta is very unique in that a lot of people come together, especially in this space. But I mean, there's definitely a need in every metro area. So
I agree.
Yeah,
I agree.
We definitely got to put the show on the road. But yeah, so I'm still just kind of reflecting off the credit summit and just taking it all in. I can't believe, was it a week ago? How long ago was it?
Today's what? Sunday was day 3 was actually today. It was literally 1 week ago.
Wow. Yeah. Wow. Yeah, no, that was it was exciting, man. And also just inspirational too. Like, I know it's different, like, interacting online, social media and everything, but then just, getting to meet a lot of the people in person. And even a lot of people who attended. I mean, I came across like a couple of people from the DMV who flew down there to attend the credit summit. And of course, all the folks down in the Atlanta area. So No, it was definitely fire. So um, let's talk about this too, right? What we're going to be talking about in this live is forbidden credit, right? And this is actually important because one thing I started to realize, right, as y'all can see right there, people can like get their credit fixed, right, from the major three: Equifax, TransUnion, Experian, right?
Mm-hmm.
But what I've started to notice recently is that it's not as easy to just clean your credit and then go get funding maybe like 4 or 5 years ago. Like in 2020, I'm seeing this a lot with credit unions.
Mm-hmm.
So they've put up additional measures outside of just the major three consumer reporting agencies, right? There's check systems, there's LexisNexis, Sage Stream, early warning, right? So a lot of these other secondary data sources out there where it's like, okay, you might get your credit clean, but then you still got to get past these hurdles. And I've started to see it a lot with the credit unions, because a lot of them, as you know, that they use check systems. I would say the majority of them, maybe like 80% of credit unions use check systems.
Mm-hmm.
And what I've seen recently, like, let's say, for example, someone overdraft on their bank account or their checking account, and it shows up on check system, right? Most people think, okay, that's what is causing them to not be able to join some of these financial institutions. But what I've also noticed is not just that. You could have, pristine records where it comes to, how you manage your demand deposit accounts, check-in and savings accounts. They're looking at your check system's inquiries. So like back in the day, we would talk about, okay, you go to this credit union to pull Experian, this one to pull Equifax, this one to pull TransUnion, and you apply to them. Then, each of them are not going to see the inquiries from the other bureaus because they're only pulling one. You could double dip, triple dip. Basically, that was a way for you to really stack up a lot of, credit without getting a ton of inquiries. So you can go to like, let's say an easy example. You pick 3 credit unions. Let's say you go to NASA Federal Credit Union, they're going to pull Experian. Let's say you go to DCU, they're going to pull Equifax, and maybe you go to Alliant Credit Union, they're going to pull TransUnion. So back in the day, or not even that long ago, you can go to all 3. You're only going to get one bureau, one hit on your bureau, per bureau, right? And then you could double dip. So you can get a credit card loan, line of credit, auto loan at each of them, just with one inquiry. Mm-hmm. But now what's starting to happen is, since most credit unions pull check systems, they're going to see the recent check systems inquiries, right? So now what credit unions are doing, and this is from conversations I've had and also just, working with clients with funding, is that they're getting credit unions are getting more sensitive to how many check systems inquiries that you have. So if they see, okay, you just open up account here, because they're not looking at the hard pulls, so to speak. They're looking at the check systems. So every time you open up, when you go to the credit unions, you have to open up a savings account. So if they use check systems, you're going to get check systems inquiry, even though, you're not getting notified like with all the credit monitoring you have with the traditional 3. If your credit gets pulled, you're going to get an email notification. You're going to know. But with check systems, you're not getting those notifications, right? So you're not really probably thinking about it that way. It's like every time you open up a new credit union account, you're getting an additional inquiry. But we don't really think of it that way. But the credit unions can see that, and it's visible. So there's a lot as far as like just other data out there that's being considered. We haven't even tapped into early warning, right? Which is owned by, I think, the 7 largest banks. So like, Truist, JP Morgan Chase, Wells Fargo, PNC, US Bank, right? So let's say, you defaulted on one of them, you cleaned it off your credit. That doesn't mean you can go to some of the other banks that are in their consortium and try to get funding. They're still going to have that record somewhere, other than just on what's publicly available, right? So
let's go back a little bit to the credit union and check system, because I spoke about that in the Forbidden Credit course. So for those of you that are seeing Forbidden Credit, it's a book, but it's a course. So I had to print a physical copy so you guys can see it, right? But it's actually a course, and we'll tell you how you guys can get access to it a little bit later on. But as it comes to inquiries, right? Now, an inquiry, when it comes to an inquiry, permissible purpose must be given. They cannot just pull your reports without permissible purpose, right? And in the Forbidden Credit book, I go over how you can get those inquiries deleted. The same way an inquiry is valid for a TransUnion Equifax Experian, it has to be valid for a check system's early warning. So if there's no permissible purpose, written permission that was given from the consumer, that inquiry cannot be there. So what people are not doing is they're not pulling their check systems. So if they don't pull their check systems, they don't know what's on their check systems. So 9 times out of 10, they're doing it blind. And that's the issue why a lot of people now are getting a lot of denial. So if they were supposed to pull their check systems, right, and clean their check systems up before applying to these institutions, then they'll have a higher success rate of getting approval. But inside of the where we talk about inquiries, there's been a new law that was updated. I also included it in the books. You guys probably can't see it. I included it in the book. There's a new law, and I go over how you can use the law now to get rid of not only soft inquiries, but hard inquiries as well that are not tied to an open account. If written permission is not given, the inquiry cannot be on their credit. And what a lot of people don't know is that you can get paid for $1,000 per inquiry. Right now, I have a 166 in soft inquiries that I'm in court for, which is 166,000 that I'm suing for. Another 66 with a different company, I won't call their names right now, and another 15,000. So I have like almost 300,000 worth of soft inquiries that I'm suing for right now.
Wait, back up a second. So explain to the people, all right, as far as what's the process? Let's say, you check your credit report, and I think we talked about this, like on your detailed Experian report, you could see all the soft pulls. As a matter of fact, every time, let's say, like a lot of these credit monitoring services, they might check your credit or soft pull your credit like every week or, however frequently. So you'll see all the soft pulls on your credit. And a lot of times, you may not even be aware what institutions are actually soft pulling unless you're looking at that detailed report. Correct. So what's the process of, let's say, suing, these companies and getting paid for it when they do soft pulls where they don't have permissible purposes? Is that something that's taught in the Forbidden Credit course?
So that particular part is not in the Forbidden Credit course. What's in there is the notice, right? So let me break it down. So your round one would be to identify the soft inquiries and the inquiries not tied to open accounts. Then the template inside of the Forbidden Credit course is going to say, hey, this is a letter that you need to send. So when they log into the Forbidden Credit portal, they'll see a video that's explaining the inquiry. Like I go in much detail, and there's actually a template now that they can use, modify it, and send out. So what that template does, it requests the permissible purpose. Using the language of consumer law, using the language, the new permissible purpose law that was updated last year, March, using that law now, they're required to send you proof that the company that pulled it had a general or specific certification and what the permissible purpose documentation is that they received from the company for them to release your information. We got distracted with a smoke screen. The smoke screen was soft inquiries or soft pull don't affect your credit score. So they want you to focus on the score. But if I'm focused on the score, why is there 300 and plus soft pulls on my report? The math ain't mathing. So you want me to pay attention to a credit score, but there's 300 soft pulls? Make the math make sense. If the soft pulls didn't matter, why isn't there 300 hard pulls versus 300 soft pulls? So when I reread the permissible purpose law, you know what the permissible purpose law said? It said nothing about a hard inquiry. It said nothing about a soft inquiry. It said written permission is required for any institution to pull a consumer's credit report. And that's when I figured it out, that they've been lying to us. They told us to pay attention to a credit score, which is FICO, which has nothing to do with your consumer report. But then I have 300 soft pulls. So every time a consumer reporting agency furnishes your report to a company, they have to buy the report. It's not free. They sold my report over 300 times. They got paid and I got none of it. So there was a party. I wasn't invited. I had to go intercept the mailman, read the invitation, and know I'm showing up because I'm getting paid too.
Wow. Now, let me ask you something about, so with a lot of these credit monitoring services where they're soft pulling your credit, whether that's My FICO, Credit Karma, Credit Sesame, whatever the case.
Credit Karma, I got some shit with them.
Okay. So I guess they're obviously soft pulling because they're not the source of information. They got to pull your credit in from the credit reporting agency. So I would imagine, and again, I'm not 100%, but is it some part of the terms and conditions, like if you're using their software, that you're accepting that or giving them permissible purpose to actually soft pull your credit? But maybe sometimes it's embedded in the language of the terms and conditions that maybe you're not really aware of it.
So let me explain this part. So I'm glad you brought this up because I ran into this issue with Credit Karma, right? So Credit Karma is going to say that in their terms and agreement, right? And I even have the letter in here too that I used to send to Credit Karma. And when y'all get the Forbidden Credit course, y'all will see I was not playing. So I'm not sure if you can see it, but you see Credit Karma? You see it?
A little bit. It's kind of blurry, but yeah.
Can you see Credit Karma? Like, I want to show the people that I'm not just talking gas right here.
Oh, okay. Hold it still. I think it's just focusing.
You should be able to see Credit Karma.
Anyways, I believe you. Don't
Credit
worry.
Karma is there. Credit Karma is there, right? So Credit Karma is going to tell me that, hey, because you signed up for a Credit Karma app, you gave us permission to pull your reports from any institution. I said, no, that's not true. Credit Karma pulls from TransUnion. They pull from Equifax. What is Credit Karma doing on my Experian 66 times?
Credit Karma. Oh, so on your Experian.
Credit Karma. Go check yours too. And I challenge everybody watching this right now.
Hold on.
Go check your annualcreditreport.com. If you see Credit Karma on your Experian, what is Credit Karma doing on your Experian? Credit Karma does not pull from Experian. They pull TransUnion.
Right.
They pull Equifax. So I can understand that. I won't sue them for TransUnion and Equifax. I agreed to it. But you know what I also did? I canceled my Credit Karma account. So if I ever see another inquiry from Credit Karma after the date that I canceled their program or subscription or whatever it is, me and them are going to have some different type of conversation. So people don't know that they can cancel a Credit Karma account. Yes, you can, right? The next thing is they don't pull from Experian. So I asked Credit Karma, I said this, okay, if I gave you that permission, I want you to provide me with the documentation that said I, Daraine Delevante, gave you Credit Karma or Intuit or whatever permission to pull my Experian. Written consent from the consumer to whom the report is related to. I never gave them written consent. You can't just group a blanket statement and says Daraine gave me permission and I can pull from all 300 plus consumer reporting agency. That doesn't make any damn sense. No sense at all. So I want proof that I gave you permission. I, Daraine Delevante, gave you Credit Karma permission to pull my Experian. They don't have it. So I got an email the next day stating that, hey, we canceled your Credit Karma account. I said, oh, okay, that's good. But let's talk about these 66 inquiries on Experian. How is that going to go? No reply. So you know what I'm going to do now? I'm going to initiate a lawsuit.
So how much money are someone entitled to based off of each inquiry?
All right. So I don't want to tell anybody. I want to show them. Are you able to do a screen share real quick?
Yeah, you could do it. You should be able to do it.
All right. So let's see. Screen share. I think we go to present.
And I'll just do this.
All right. Let's see. Share screen. Let's see. Okay. All right. So let's see. Chrome tab window. I'm figuring this out, guys. Give me a minute. Don't be judging me right now. All right. Y'all are not judging me right now. Because if you are, I'm gonna just stop. All right.
And by the way, anyone interested in getting set up with the Forbidding Credit course, there's a link in the description of the video. So make sure you do that. All right. So there we go.
And can you see the screen?
Yes, sir.
All right. So right here, we're at 15 USC 1681 and civil liability for willful noncompliance, right? And this is what the law says. Any person. So let's go find out what the word person means. The term person means an individual, that's you and me and the people watching. Partnership, that's a corporation. And here, corporation. Credit Karma is an LLC. Experian is an LLC. Equifax is an LLC. TransUnion is an LLC, right? So that covers them on the person. So any person who willfully fails to comply with any requirement imposed under this subchapter with respect to any consumer is liable to that consumer. So now that we know that, before we go here, let's go up to permissible purpose, right? And subject to subsection C, any consumer reporting agency, so that's your Equifax, TransUnion, Experian, Credit Karma, LexisNexis, SageStream, ARS,
Right.
any consumer reporting agency may furnish a consumer report under the following circumstances and no other, right? Number one has to do with court, getting a judge order and stuff like that. But number two says, in accordance with the written instructions of the consumer to whom it relates. Written instructions. So you have to give written instructions. So I want to know, when did I give Credit Karma written instructions? I did not. To pull Experian, I did not. So what we need to know now is this. Under civil liability for willful noncompliance, it says that here, in the case of liability of a natural person for obtaining a consumer report under false pretenses or what? Knowingly without a permissible purpose, actual damages sustained by the consumer. So actual damages would mean, let's say that it was hard inquiries and not soft inquiries, right? And you know that if you have too many inquiries, you will get denied for a line of credit, right?
Right.
So an actual damage would be something like that. So if I wanted to go get my Mercedes-Benz AMG GLE Rocket 900 and I got denied as a result of hard inquiries from Credit Karma, then I could do that because I never applied for anything through Credit Karma, and they did a hard pull, which lowered not only the credit score, even though it's not a factor, but it's a contributing factor. But they also caused me to be denied because I'm being looked at now as I have too many inquiries. I'm constantly applying for lines of credit. My character is not reliable. So there's defamation of character and all sorts of things that can follow actual damages, right? Now, it says here, or, you see this word or changes the game. It says $1,000, whichever is greater. So in retrospect now, when it comes to the soft inquiry, you won't get actual damages for that because it did not affect your character, your reputation in no form or way. So the or no would be the clause that stands firm. $1,000 for what? Accessing the consumer report knowingly without a permissible purpose. So for every inquiry, it's $1,000. I had 66, which equal to 66,000.
Now, one of the obvious places where I think this happens a lot is going to be when people go to the car dealer, right? And they say, okay, we can get you a better rate, but they don't tell you that they're about to hard pull your credit like 10 times, right? And sometimes like you really have to be firm. Like, look, I mean, you shouldn't be trying to get dealer financing anyway. You should always come with your financing in hand. But that's one of the obvious places. And I think what happens is a lot of these auto dealers, obviously, they're getting kickbacks from some of these lenders for loans that they close, right? But then they're also playing off the desperation of a lot of these borrowers who, like for example, when I financed my first car, I didn't really care what bank or what rate. Like, I didn't care, I just wanted to make sure that I drove off the lot. And I think a lot of people who are in that situation, they will overlook things like this, like, you know, letting them get away with certain things. Like they're just going to pull their credit without officially authorizing it. So that's one area I think where it could potentially happen a lot. But another thing I realized too, I'm not going to name the financial institution, but, you know, I experiment with different financial products. So one of them was a secured card where they automatically hard pull your credit for graduation. Like when you start with a secured card and then you go to an unsecured, they'll do a hard pull of your credit before they graduate you, right?
Really?
And this is something I didn't know. So I remember one day I just seen a random hard pull. I thought it was like identity fraud or something like that. And then I looked to see what institution it was, and it was like, oh, okay. And then I noticed I gotten a email that said, you know, congratulations, your card unsecured, you get your deposit back, and we're going to increase your limit. But it was something that wasn't, I guess, communicated, at least from my perspective, was not communicated, you know, when I put that deposit down, you know, probably like a year earlier. So it was just kind of random, right? So I'm just, now that you're mentioning it, that seems like a case where I definitely didn't authorize my credit to get pulled, and it did. I wasn't tripping, you know, because inquiries, you know, unauthorized inquiries, we can get those deleted. But it was interesting. Like, I think that could have been an instance, right?
Well, we have to evaluate their terms and conditions. So what if there was language in their terms and agreement that said, hey, all right, we will not do a hard pull right now, but upon graduation, if we deem that your account has met the standards for this,
that's possible.
When your account becomes unsecured, we may do a hard pull to see how much line of credit we will extend to you upon graduation. So if there's a language similar to that or in there, which I probably think it is, because they are notorious for using double language, saying one thing when they mean another. And they will not tell you this up front. Oh, you signed the agreement, it's in there. Okay, show it to me, right? So I'm always asking for the proof. If it's in there, I'll back off. But if you can't find it, best believe nobody's safe, right? So there could have been deceptive language in there like that they did not bring to your attention.
I mean, let's be real. Who really reads through all of the disclosures when they apply for credit?
I start doing it.
I know you do. I mean, I think with like big things, right? If you know, you're making a big purchase, or I mean, even you know, like, let's say if you're buying a property and, you know, at closing, you have these, you know, hundreds of pages of documents. I mean, I remember like we had to hire a title attorney to, you know, help interpret that language. Right. So, but just with basic things.
Why couldn't it be so? Why do I need an attorney to read my own contract? Why? Like, if you have to get somebody else to read your contract, it simply means that there's deceptive language and there's things in there that is not in your best interest. Because if it was good, right? If everything was good, it would have been in layman terms. Hey, credit plug, you're buying this house. This is what the loan, the life of the mortgage is going to be. But no, the language is so deceptive that you can't make it out. I can't make it out. And if I go assume that I know what you mean, I set myself up for disaster. I have to go pay somebody else to come and interpret. Like, how does that, tell me, how does that make sense? It does not. These contracts are so deceptive, and the language being used, the normal person will never comprehend it. It's
right. Deceptive. And they know that. They know that. And they know the average person, you know, let's say 99.9% of people are not going to sit down, take the time to read through hundreds of pages of legal jargon. And even, you know, if you're able to read through it, to even interpret it and understand, you know, what it means, what the ramifications are. So like in complex, you know, transactions, I think it's worth it to just, you know, have an expert, you know, opinion on it. But even just basic things like, you know, loan contracts and things like that, like you got to read the verbiage. And I always tell people this, you know, you're taking out a big loan, whether that's auto loan, a mortgage, a personal loan, make sure you're looking at the amortization schedule. Because a lot of times, like, we've gone over this, before. When I financed my first car, I didn't look at the amortization schedule and really see, okay, I thought, let's say your car loan is $10,000, right? And your note is 500. I thought if I paid the 500, the balance goes down to 9,500, but that's not how it worked. I paid the 500, the balance goes down to $9,950.
And it goes back to the fraud when purchasing a home. In your 5 to 7 to 10 year period, they come swindle you into a refinance, and you think that you're saving 1% on an interest rate when you just reset the interest rate.
You're resetting the front loaded interest.
It's deceptive. So 10 years now, you're paying on this mortgage, 15 years, because you want to refinance every 5 years, only to find out that only 30% of the principal has been paid. Can you imagine? You're halfway through at 15 years, only to find out that you've only paid down 30% of the principal. And majority of your payments has been going towards interest because you refinance every 5 years, and you fell into the scam that the banks give y'all, telling y'all that we're going to get you at a lower interest rate, not looking at the bigger picture, where majority of the front load of your payments go towards interest, and you just got swindled. And
all right. It's the same thing with auto loans, the same thing with personal loans.
Auto loans. So even with auto loans, right? There's two type of interest that they're getting from the auto loan, right? They're getting
it's different.
End. Yeah, they're getting the front end part, right? Just like what happens with the mortgage, but they're also getting more because they violate what is called your state usury law. Not a lot of people know about the usury law, where they're charging you excess. So like states like New York caps at 16%, Florida 18%, I think North Carolina is 6%. There's different interest rates for different places. You're in DC, right?
Yep.
What's the usury law for DC? Just type in Google, what is the maximum usury law for DC? And you'll see how much that percentage is. And my next question that follows is, when you got the first car, were you living in DC?
No, I was in Maryland. Okay.
So let's find. Go ahead.
So I pulled it up. I don't know if this is true, but it says they're saying a rate of 6% per annum.
Yeah, annum is per year.
Okay, that seems kind of low though.
That's what people are supposed to. That's the maximum. It doesn't matter what I think or what you think. That's the law. But because they know the regular person don't know this, they're going to charge 15, 25, 30, 35%. Now let's go to Maryland, where you got your first car from. What is the maximum usury for Maryland?
Let's see.
I'm gonna show, like they're genius at their games, bro. They had the money and the resources to do the research, and they have the money to pay the lawyers to double language the contract. So you're going into this contract not even knowing what's going on.
All right, hold on. Let me share my screen real quick. All right, so let me zoom in a little bit more.
Let's see what's popping over Maryland.
All right, so it says the legal maximum in Maryland is 6%, but can be 8% under a written contract. There are also exceptions for mortgage loans, installment contracts, for automobiles and other consumer goods. So right here says legal maximum rate of interest, 6%, and up to 8% in written agreement. So look, exceptions include mortgage secured loans, unsecured loans secured by other than savings, installment loans not secured by real estate, open-ended retail contracts, installment sales contracts for motor vehicles and other consumer goods. So it says, obviously, the best way of avoiding getting in financial trouble with high interest credit cards to avoid credit card debt. So basically, though, with all these exceptions, right? Let me, I don't know if I could zoom in a little bit, but with all these exceptions, all right, so mortgages, unsecured loans, installment loans not secured by real estate, open-ended retail accounts, So like what types of products would fall under it? Because it seems like everything that you would be paying a higher interest rate is an exception, right? So
Well, then we need to find out what the exception for that particular part is. So I would then look at, okay, what is the exception rule or the exception usury law for an installment loan in Maryland? So that's the question now that I would.
So it's basically saying, okay, this is the legal maximum, right?
Mhm.
But except for mortgages, unsecured loans, retail contracts, and installment sales contracts but so that includes most products that people would be applying
Right.
for.
So even though there are exceptions, and if they did not produce a number, I would still lean towards the state legal maximum, which is 6 to 8%. So unless they can prove otherwise, where the state allows them to do that, it says exception, but how much is the exception? I don't know.
Right.
So unless I go through those laws and find the exception, I'm going to lead towards what my state maximum legal is.
Exactly. So I want to back up a little bit. So you made a point about the interest rates. I wanted to go over as far as with auto loans, right? How that's one of the biggest finesses, if you will, where it's a different type of interest, right? So you have simple interest, and then you also have daily accrued interest. So I don't know if you heard recently, but Navy Federal made an announcement that they're changing the way that interest is calculated on their credit cards. I'm not sure if you heard about this, but basically, daily accrued interest. So I want to just share with you a quick definition of this. All right. Because a lot of people have to understand essentially like what the difference is, right? And how you would potentially be paying more, right? So let me just read this, right? So, all right. So the financial term accrue means the same thing as accumulate. Daily interest accrual refers to interest that accumulates daily and is added to the balance of an account, right? So borrowers can dread interest accruing on balances that they owe on a credit card account, mortgage, or student loans. Investors, of course, they like that, right? So, but daily interest accrual can compound. So pretty much it's interest on top of interest. For those who don't understand the difference, right? So you have simple interest. So let's say, for example, you take out a loan for $10,000 at 6%, right? At the end of the year, you would owe 6% of that, which would be $6,000, and basically spread across the entire year and include it in your principal and interest payments. Whereas daily interest accrual, let's say you figure out, okay, what's the daily interest? So you would take, let's say, $6,000. Let's say on $100,000 loan, $6,000 in total interest divided by 365. That'll give you the daily interest accrual. So you take that one day's worth of interest, add it onto the principal balance. So then the next day, that 6% is going to apply to the interest that accrued previously, plus whatever that balance is. So it's interest on top of interest. So you're paying interest on top of the interest that accrued daily. Like it's crazy, because then it just continues to increase your balance. And I always notice this as well, right? Like if anyone's paid down like an auto loan, right? And you're still wondering like, wow, like I paid it all the way down. Why does it feel like the balance is still increasing as you're paying down that balance, right? And I noticed too that with, like, for example, auto loans, as far as like the interest accrual might be different than, let's say, if you have a line of credit, right?
You see, credit plug. You see where people see catastrophe, I also see opportunity. When you change the things you look at, the things you look at will also change. Well, this simply means that now Navy Federal will totally be in violation of most states' usury law. So all I got to do now is do the calculation to calculate the amount of interest that I'm paying now per year and see how much of that interest has exceeded my state maximum usury, and this is what I'm going back to Navy Federal for in a lawsuit. So where most people are going to say, oh my God, I'm going to be paying so much in interest rate, I'm looking at how much I'm going to be able to sue for, because now I'm talking about loss of opportunity, financial opportunity, deception, deceptive practices, state law violation. Oh my God, I don't even want to curse on here. But where other people see issues, I don't see that. So my brain starts working. Okay, Navy Federal, if you think you're finna get over on me, you got a next guest coming, because I know that there are consumer laws that protects me, especially when it comes to interest rate, the usury law for each state. So all I got to do is run the goddamn math, run the math, and I see now, oh, you are allowed, Navy Federal, if I'm in the state of New York, you can only charge me 16%. So when I do my calculation for daily plus what I'm paying annually, and I put those together and I add those up, whatever the difference is, I am suing for it.
Yeah.
So I just have a different perspective when it comes to things like this. It just gets me excited. I'm just saying.
So I don't mean to hijack, but I wanted to just share this real quick, right?
Yeah, go ahead.
So I went over this. I've done a couple videos on this, right? So this is called a call report, right? NCU, for every credit union that's falls under NCUA. Basically, every quarter they publish these reports, or they're required to do these call reports. So right here, I have Navy Federal's call report. This isn't the most up-to-date one. I think it's as of June.
Give us some more context. So what is a call report? Because
so basically, you know, they're talking about the overall performance of in financial standing of the credit union, right? So they have, you know, published financial information, loan information. So I wanted to share this real quick. So this is one of my theories on why I believe Navy Federal basically switched up as far as, you know, how they're calculating the interest, right? And it's actually quite striking, right? So right here, I don't know if you can see, Daraine, it might be a little small on your
you can see it. Go ahead.
On your screen, but let me zoom in. So this right here shows Navy Federal's delinquent loans and leases, right? And so this is as of June 30th, 2024, right? And it has it broken down like this first line item, unsecured credit cards, right? And each category, so this first column right here, 30 to 59 days, 60 to 89 days, 90 to 170, 180 to 359. And you notice after 365, it goes zero for unsecured loans. And most of these, you know, new car loans, used cars, real estate, or not non-real estate loans and lines of credit, is because after 360 days, it goes to charge off, right?
All right. So that part right there. So I want to jump in right here. So when it goes to charge off, they've removed it from their books. That's why you're seeing zero there. It's been charged off to profit and loss. Now, what they do here, so because of the bank, there's a banking rule that says between 180 to 120 to 180 days, they have to, and I spoke about it in this book. I'm going to go find that banking law. Can't seem to remember it.
Okay. While you're pulling that off, so basically, after a while, so after this 365, so the credit cards, unsecured loans, lines of credit, auto vehicle loans, those basically go to charge off. Now, as you can see with like real estate, it doesn't, right? Because, you know, they still have those are backed by collateral, right? But then the next page over, you know, it moves into this charge off you know, page. So this shows loan loss based off of all these categories. So you see right here, this is $1.15 billion in unsecured loan charge-offs. And this is just in the year, right?
There's two parts to that, you know, brother. There's two parts to it. So front end, right? So front end for accounting purposes, you're seeing zero there because the Uniform Retail Credit Classification and Account Management Policy, that says they have to charge it off at 120 to 180 days. So if, let's say, Navy Federal was going to be acquired by another company, right? Their books have to be clean, and they can't have these accounts listed as assets when they're not. That's why you see zero, so they had to get rid of them. However, when these lines of credit were being generated, there's a thing called the finance charge, 15 USC 1605. Inside the finance charge, there's an insurance policy. You remember when we went over that?
Mm-hmm.
The insurance policy is in there. So it protects the credit life. It protects the lender in the event that the obligor defaults. Well, even though it's on their book as a loss, they still got the insurance money. So what we think they're not getting the money back, they got the money.
Oh,
through their insurance.
Here's another thing too. So on this charge off page, right, it tells you the charge offs, but over here you also have a column for recoveries, right? So what they've recovered in relation to what's been charged off, right? So this is money that they've been able to collect, right? And again, it pales in comparison to the total charge-offs. But from what you were saying, okay, they're basically made whole due to the insurance, but then also whatever else they might be able to recover, right? That goes back to the bottom line, right?
Correct. Including all the payments the consumer made, all the payments, all the down payment, all the interest rate that the consumer made. Plus, then they send those accounts to collections for collecting.
LVNV.
So that's why these banks are. How can a company that does not have money, because there is no money in America, negotiable instrument, all they have are numbers on a screen. How does a company that has no money make so much money? They operate under a different rule. They operate playing a different game. And who gets to feel the blunt of it? The consumers.
The consumers, yep.
We're the ones left holding the bag because they know they got paid from the insurance policy because it's in there in the finance charge. There's a finance charge involved. There's a protection for that credit life and the life of the loan if the obligor defaults. It's in the law.
Now, let me ask you this, right? Because I've seen in cases where, let's say you get approved for a credit card, right? And it'll ask you, do you want to enroll in some type of let's say if you wind up not being able to repay, and they'll say, okay, we'll charge you $1.50 for every $1,000 that you default, right? It's usually like an optional. I don't know what to describe it, like an insurance for the consumer that will basically cover them in the event that, let's say, they're unable to pay because they got laid off or they have a disability or death or whatever the case is. Is that kind of related to this?
No, that's another swindle.
That's different. Okay.
The finance charge itself already covered the life of the loan, the credit life, and protects the up. Let's pull it up so people can see it. 15 USC 1605.
Go ahead. You can share.
So what they're actually getting now is they're getting their cake and they're eating it 2, 3, 4, 5, 6, 7, 8, 9. That's what's going on. So when we go to Truth in Lending, 15 USC 1605. Share screen, Daraine. Let me figure this out again. Here, share screen. Share screen. Let's do window. Let's do window. Okay, where are we? Okay, we're right here. Share. All right, boom. All right. So let's go to Truth in Lending. 15 USC 1605. Determination of the finance charge, right? Can you see it?
Yep.
Okay, 15 USC 1605, determination of the finance charge. Finance charge defined, except as otherwise provided in this section, the amount of the finance charge in connection with any consumer credit transaction shall be determined as the sum of all charges, payable directly or indirectly by the person to whom the credit is extended and imposed directly or indirectly by the creditor as an incident to the extension of the credit. The finance charge does not include charges of a type payable in comparable cash transaction. Like I told you before, there should not be any cash transaction where a finance charge is involved. It's illegal. The finance charge shall not include fees and amounts imposed by third-party closing agents, including attorneys, settlement agent, escrow, title companies. You got to pay those fees out of pocket. If the creditor does not require the imposition of the charge or the services provided and does not require and does not retain the charges, example of charges which are included in the finance charge include any of the following types of charges which are applicable, right? And then when we go to number 1, it says interest, time, price differential, and any amount payable under a point. All right, that's cool, not important. Service or carrying charge. So when y'all are at dealerships and they try to swindle you into paying like these dealership fees, dock fees and stuff, those are crooks. They should not do it because what? Loan fee, finder's fee, or any similar charge is covered in the finance charge. So all those fees the dealership charges you, you're not supposed to pay them. Those are covered in the finance charge. Fee for investigation of the credit report, right? They shouldn't charge you to pull your credit report. But number 5 says what? Premium or other charge for any guarantee or insurance protecting the creditor against the obligor's default or other credit loss. The account is protected. But not only that, borrower paid mortgage. We're not interested in that. Look at this one. B, life, accident, or health insurance premiums included in the finance charge. Charges of premiums for credit life, the life of the credit is protected. Accident or health insurance written in connection with any consumer credit transaction shall be included in the finance charge. So as you can see, the coverage of the debtor by the insurance is not a factor in the approval by the creditor of the extension of credit and as this fact is clearly disclosed in writing to the person applying for obtaining the extension of credit. They will never tell you that there's an insurance policy built inside of the loan. Like it's all there. It's all here. And these are the type of institutions that we're dealing with that knowingly withhold or withheld pertinent information from the consumer, making the most accurate and most informed decision. They're all crooks, bro. All of them. And if you don't learn how to play their game, the people that don't know the things you don't know will always take advantage of you. And it's one of the reasons why the Forbidden Credit course was created, is for people to wake up. You need to wake up from the system. You need to learn your rights, because a consumer who don't know his or her rights, you have no rights.
That's a fact. That's a fact. I tell people this all the time. You know, you have to educate yourself, especially in the world of finance, credit, contracts, you know, whatever the case is. And you can't always, I know sometimes, you know, dealing with, let's say, household name organizations, that does not mean they don't make mistakes, right? Like,
you want receipts? Tell me you want receipts, because I'll give you some receipts right now. Don't get me crazy today.
Yeah, I think people look sometimes at these household name like corporations and think, okay, when you're engaging in business with them, you know, they have your interests at heart. But I mean, nearly every major company, bank, institution has been sued or has pending, you know, lawsuits for violating consumers. Case in point, I mean, TD Bank just recently had a I forget how much it was. It was a couple $2 billion penalty that they had to pay for.
Let's go, because you done started me now. Yeah. You cannot undo this, Credit Plug. You started this. so your people that are watching, guys, Credit Plug started this. Wells Fargo, $3.7 billion lawsuit for fraud, illegal repossession, illegal foreclosures, illegal adding interest rates to people's credit, to people's accounts, illegally opening up accounts, swindling different fees for open accounts, right? Bank of America, 200 million. I'm sorry, 200 million, right? And they got hit with fraud, opening accounts, applying mispayments, swindling consumers out of the perks that their credit card is supposed to give them, not giving them the credit card benefits, right? Then we have TD Bank for money laundering. Like most people are so naive to think these institutions have their. Do you know how much money they make from frauding you? Do you think the fine that they're getting from the CFPB or the FTC is nothing? They can pay that off for just what they made from late payment fees.
Yeah, that's a slap on the wrist. They're not
16
really
million. The Wells Fargo case said over 16 million people were affected. I want you to do a math for me real quick, bro. A late payment fee gets charged every month. 16 million multiply. How much is it for a late payment fee right now? Like what? $25, $35? How much is it?
I think like 20. I forget.
So let's use $35 for. I think it's between that. It's either between $25 to $45. So let's use 35 as the median number, right? Do some calculation for me. $35 multiplied by 16 million consumers that were affected.
Okay, so you said 35
multiplied by 16 million.
That's 560 million.
Multiplied by 12. You get that late payment fee every month. So that was 1 month.
6.72 billion.
Okay. I rest my case. And they just paid the CFPB half of what they made off a late payment alone. So if I'm going to get hit with a fine for 3.7 billion, but what I'm doing makes me 7+ billion.
You still profited.
Come on, bro.
And the thing about those penalties is like it's not even an exchange of anything.
But bro, that's just late payment. We didn't talk about the other payments like the accounts that they opened, the overdraft fees. We didn't go in. That was just one business model. That was just late payment alone. Late payment alone for Wells Fargo is $7 billion. You think they're gonna stop? Please. A corporation cannot go to jail. Have you ever seen your documents in jail? Have you ever seen your paperwork in jail? No. So all they'll get is a slap on the wrist, too big to fail.
Here's another thing too. A lot of people don't pay attention to is the minimum monthly maintenance fees, right? So if you don't have, for example, with certain banks, if you don't keep a certain amount of money in your checking account, they're going to charge you. I think Chase charges like $12 if your balance doesn't stay above whatever their minimum. I'm not even sure what it is, but
what type of maintenance fee, Credit Plug? What are they maintaining? What? Please tell me.
It's the privilege for them to hold your money, I guess.
They don't hold your money. Fractional reserve lending. They lend that shit out. What you're being charged for is not having enough money in there for them to lend it out. That's what. See,
that makes more sense. That makes more sense.
They're not going to tell you this. You're not getting charged for them to keep your money. You're getting charged for them not having enough to lend out. That's why you're being charged. What type of maintenance? What are they maintaining? Because all it is numbers on a screen. They're not physically lifting up cash and taking it upstairs, locking it into the vault. You're not doing that shit. It's numbers on a screen. Zero maintenance required. Oh, see, you got me started today, Credit Plug. Shit. You got me started today. Let me calm down. Daraine, calm down, because I know we're coming to an end. Let me calm down. Let me calm down. Usa. Saying it so passionate doesn't make me more right. So let me get my blood pressure back down. Yo, I'll be passionate about this stuff, guys. I'm telling you. And like this is going to change a lot of your life. Like I said before, it's not a book, it's a course. You will get the ebook copy of it because this physical book is nowhere online. Nobody has this but me. And if y'all had came to the Credit Summit, y'all know y'all would have gotten it. Apart from that, this physical book is nowhere. It's a course. And the course, I'm quite sure Credit Plug has it here somewhere.
Link in the description, yep.
Yeah. So you guys can go and start and take your power back. Stop being the victim. You guys need to be victorious. Stop being the victim.
Absolutely, man. So
Come on.
yeah, so if you're looking for just a lot of the information that most people don't know, right? Definitely check out Forbidden Credit.
Yep.
Daraine breaks it down. A lot of the consumer law. I mean, a lot of ways you're not even aware that you're being violated when you really are. So this is going to allow you to take back a lot of your power. And as Daraine mentioned, also get compensated for these institutions violating your consumer rights. So is going to arm you with the information so you can make better informed decisions on how your information is being utilized and who has access, who has permission for it. And if they're not abiding by these laws, then there's a framework for how you could get paid cash money. How much did you say, Daraine? 300K, something like that. You got pending.
For me, it's $1,000 per inquiry.
$1,000.
It will vary based on the amount of inquiries a person have. Soft inquiries or hard inquiries not tied to an open account where there is no permissible purpose.
And look, I've seen people holding up the checks. So this is a real thing. Like people are really getting paid for this. So definitely check it out. I mean, there's a link in the description of the video, so y'all could definitely tap in. And again, Daraine, pleasure having you on. Like we mentioned earlier, we're definitely gonna have to get something in the works as far as this credit summit coming up next year, or maybe we could have multiple of them. But definitely a lot of great information. And again, even myself, I'm learning a lot of this from Daraine, from a lot of other people in the industry who specialize in certain areas. But when it comes to the consumer law, Daraine Delevante, man, that's the GOAT right there. That's the GOAT when it comes to consumer law. So y'all definitely check it out. Forbidden Credit. Link in the description of the video.
Link in the description.
Let's get it, man.